Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following out of the BNN Bloomberg newsroom. The Bank of Canada warns the country's weak productivity growth is a systemic problem that needs to be urgently addressed by governments and businesses. Speaking in Quebec City, the Deputy Governor, Nicholas Vincent, says Canada is stuck in a vicious circle and outlined solutions that include drawing investment back into the country and increasing competition. The U.S. Bureau of Labor Statistics will not publish an October employment report. The agency says the data could not be collected retroactively. It will instead put the October information into the November report, and that will be published mid-December. The Bureau will extend the collection periods for both surveys. Some economists say delaying data will continue to cloud the outlook for the U.S. Fed. We're watching shares of Barrick Mining today. The company shaking up management after reports Elliott Management has built up a large holding. Bloomberg has obtained a letter to employees signed by Barrick's CEO mentioning changes to the regional operating model. Two senior managers, a top executive, are departing. Shares of Metro edging higher today. The grocer reported profit and revenue in its latest quarter that topped expectations. Sales grew more than 3% to $5.1 billion. Now, the company's frozen distribution center in Toronto also restarted up last week after being down for several months. Here's where we stand on the markets today. They've come back to life. The TSX 193 points up today to 30,230. Let's cross the border and have a look. The S&P 500 gaining 29 points today. The Dow Jones up 39 points. The Nasdaq gaining 171 points so far on the day, about 0.75%. As we mentioned, Barrick Mining is apparently overhauling its operating model and bringing in some new management. Let's bring in BNN Bloomberg's Lindsay Biscaya on this. What do we know so far?
Well, this was an internal memo that went out to employees today, and Bloomberg obtained this internal memo. It was sent out by CEO Mark Hill outlining some of these changes. And he was saying within that memo, this is in a bid to improve performance. So some of the big things in this are a big shakeup when it comes to management. We've got two senior managers and a top executive who were departing today. That was announced in that memo. And it was also announced that those positions have already been filled. They've already been replaced with new management. They also announced in the memo one of the company's giant mines, one of their big mines in Dominican Republic, will be moved to Barrick's North American unit. So this was previously part of Barrick's Latin America and Asian Pacific unit. And this is going to move to strengthen Barrick's North American unit, which is already arguably pretty strong because of a big mine they have in Nevada as well. So it's a big shakeup here is what we're hearing, and of course follows operational difficulties, cost overruns that the company has been seeing. It hasn't been a great year for Barrick Mining so far, but this also comes amid rumors that the company is going to split into two entities. That's the other big news we're following, of course, trying to confirm that. I have reached out to Barrick Mining on all of this, and they just responded with a no comment. So we're still waiting to get confirmation on that. But we did speak with Martin Pradier today at Veritas Investment Research, and he had something really interesting to say when it comes to splitting this company into two entities. So one would focus on the North American side of things. The other would then focus on the operations in the Africa and Asia areas of the world. And he was talking about whether investors would still be interested in either of these two entities given the troubles within Barrick Mining. And here's what he had to say.
I was in a meeting with management a week ago, and when they were asked about splitting, they said, no, we don't want to split the company. But the reality is that sometimes, the events force them to do that. And the new reorganization, it might be the split, right? Now you put Pueblo Viejo with North America. That's the most stable part. And then the rest is a little bit more risky if you want. So it looks like it's moving in that direction.
So the idea here, of course, would be to improve the share price of the company. As you just heard, maybe some management within the company not happy about this, but they are getting some pressure outside potentially.
Yeah, some of that pressure coming from, I imagine, Elliott Management Investment, which now owns a big stake.
Yes, so that's reports as well. Again, trying to get that confirmed independently. Bloomberg has reported that, one of the many outlets that are reporting that there is a big stake being built in Barrick Mining by Elliott Management. It would amount to about at least $700 million US. And a lot of these changes we're hearing about from Barrick, reportedly coming from pressure from Elliott Management. They've done this before with other Canadian companies. In 2022, Elliott Management led a successful shakeup of Suncor Energy in Calgary. Also in 2022, Elliott worked with a Toronto-based Kinross as a share buyback, and now Kinross has been one of the top-performing large-cap gold stocks. So potentially good news for Barrick Mining, but again, these are all just rumors, speculation, reports, and we're trying to get it confirmed. Elliott Management did not get back to us when I asked for comment, and as I mentioned, Barrick said no comment.
Okay, so a lot of information still to be confirmed, but it's definitely roaming out there. Thank you for that. All right, markets rebounded a bit today after some early week declines and being hit last week. It was volatile. Investors are waiting for that earnings report, a key one from NVIDIA, that will gauge the current demand for the AI sector. Let's go to Paul Christopher, head of global investment strategy at Wells Fargo Investment Institute. Thanks for joining us today.
Pleasure.
The markets seem to be turning a corner. How would you describe the last sort of week to 10 days?
I would call it a period of churn, obviously, in prices, but it's not a big sell-off here. We're not seeing everything being sold off at once. It's more like a rotation where the growth stocks, especially the tech, obviously, have rotated to underperforming, and you're getting these defensive sectors like healthcare and staples, consumer staples, are rising to the top. So that tells us a little bit, this hints that investors are really just waiting to see how the rest of the third quarter earnings play out, especially today's.
Okay, so do you see this as isolated to money moving away from tech or tech related as well?
Yeah, it's tech and tech related. The whole data center play has been an ancillary trend to AI all along, and its performance, that ancillary trend's performance through utilities and industrials, has been really mixed the last couple of weeks, sort of in limbo, as you might think, but it's really noticeable that you're starting to see these defensive, the value plays coming to the fore and outperforming. But that also tells us that this isn't just a big broad everybody sell everything. It's more of a let's wait and see and put some money in defensives for the time being.
Yeah, it's interesting because instead of seeing sort of all tech move one way, you're seeing bits and pieces. Some of them are gaining, some of them are definitely not. We have earnings from Home Depot this week. We had earnings from Target today. From what you've seen, what does this tell you about one of the key market drivers, which is consumers?
Yeah, overall, I mean, we think the good news is that, well, two pieces, really. One is that consumers are on solid ice here to kind of look ahead to the wintertime. Consumers are on solid ice. We're seeing good deposits. We're seeing adequate savings. We're seeing limited increases in borrowing. Yes, there are some problems on the margin. If you look, for example, at subprime autos, those are very weak.
Okay, we may have lost our connection there.
Right now, so especially those lower income quintiles that we tend to worry about the most. Will they be more value conscious? Absolutely, this holiday season. And so the consumer, we think, is maybe a little bit stretched right now in some areas. But when we get to next year, that's when things, we think, start to turn really positive, especially starting in the U.S., with these tax refunds that we're expecting, an above average tax refund season, probably starting in February and going all the way through April. That should really give consumers a boost here, not to mention the boost that companies will get on their CapEx spending, their plant and equipment spending. They'll also participate in the refunds come 2026. When you combine that with low interest rates, deregulation, and continued what we think will be significant AI spending, we think 2026 is shaping up to be very good. This is just maybe a slowdown, soft spot for the economy and the consumer.
Okay, so with this pull from money in tech and rotating, as you mentioned, to other sectors, are you using the opportunity to buy? If so, what are you looking at these days?
Yeah, great question. We actually have been taking a value-oriented approach all throughout these last months. And in August, we thought communication services, another tech-oriented sector, got a little bit overpriced. We took it back to market weight from overweight. And on October 30th, we did the same thing with information technology, took it from an overweight back to market weight. And what we're looking for here is to find ways to continue to play the technology trend, which is AI, but it's even more than that. It's cybersecurity, it's automation, it's digital payment systems. All of this we think is going to be important going forward, but we don't want to overpay. So we'll take expensive sectors back to market weight. We still like utilities. We still like industrials. The valuations there are not as extended as they were in IT and in comm services. So we'll stay there for the time being. But we took the money from IT and really from other parts of the portfolio and put it into emerging markets. Yes, emerging markets, the home of cheap toys and commodities, has really turned into more of a commodity play, more of a technology play going forward. Taiwan, South Korea, China. And so we think that also is undervalued right now. We put some money into emerging markets, taking those up to neutral levels for the portfolio allocation. So that's been our strategy. I think we'll continue.
Okay. What about fixed income?
Yeah, and fixed income, it's a little bit more limited and a little bit narrower there. The Fed is cutting rates. We think they will continue to cut rates. This whole issue of whether they cut in December or not, this is just a headline, a bit of noise. The trend is lower in short-term interest rates. We believe the Fed will cut further. So we want to be underweight short-term fixed income. And we do think there will be some volatility on the long side of the maturity spectrum, the yield curve. And so we've been underweight there for a time. We've really focused our attention there on intermediate range maturities. Think 3 to 7 years, corporates, build your bond ladder around that, and then also take some munis. We like the U.S. muni space, general obligation, and revenue bonds, A-rated and better. Again, thinking about quality and maybe a more focused approach to maturities going forward.
Okay, just to your last point, you had talked about what themes you think will carry out for the end of the year. Do you think that'll carry on for the next year as well, which is AI sort of extended themes?
Yes, we do. We think that will continue, and it's got some strong momentum. But it's important also to note that policy will have a role here in reinforcing the trends that are already in place for technology spending. You give firms the big CapEx deductions and research and development deductions on their taxes, you will help to encourage this trend. Small businesses will also be able to participate with lower interest rates, lower borrowing costs. We think all of these things converge. The trends in tech and the policy will converge to produce a pretty good year for investors. Our year-end S&P 500 target for next year is a range of 7,400 to 7,600.
All right. Good to know. Paul Christopher, thanks for joining us. Paul's
Thank
head
you.
of Global Investment Strategy, Wells Fargo Investment Institute. We're watching shares of Brookfield today. That company partnering with NVIDIA to introduce a $100 billion global AI infrastructure program and fund. More in a moment. Prime Minister Mark Carney is left for a week-long trip to the United Arab Emirates and South Africa. It is his latest trade-seeking mission. CTV's Rachel Aiello has more.
Prime Minister Mark Carney is embarking on a nearly week-long trip to the United Arab Emirates and South Africa. And he's hoping to return with stronger diplomatic ties, as well as new trade and investment agreements. Visiting two of the world's largest emerging markets, Carney is hoping to attract capital to Canada to help build major infrastructure projects and fuel this country's energy, defense, and technology sectors. The Prime Minister's first stop will be in Abu Dhabi. There, he will meet with the President of the UAE. It will be the first visit from a Canadian Prime Minister since 1983, when Pierre Trudeau went and brought a then young Justin Trudeau with him. The Prime Minister will also meet with heads of major investment funds and deliver a keynote speech to a business crowd. Carney will then travel to Johannesburg on Friday. While there, Carney will meet with South African President Cyril Ramaphosa, and senior officials say they're hopeful the two countries can come away with an agreement to boost bilateral trade. But the main event will be the G20 Leader Summit taking place this weekend for the first time on the African continent. On the sidelines of the summit, Carney is set to hold a series of bilateral meetings. And while his office won't yet say which world leaders he may be sitting down with, we know U.S. President Donald Trump won't be one of them, as the Americans are boycotting the G20. Rachel Aiello, CTV News, Ottawa.
TJX, which owns TJ Maxx and Marshall stores, had solid sales in its latest quarter. Consumers are being picky about where they spend their dollars in the U.S. The discount retailers often benefit. Here to tell us more about this is Dylan Carden. He's a consumer research analyst at William Blair. Thanks for joining us today.
Thanks for having me.
So the company's doing well enough, it actually raised its guidance. Tell us about it.
Sure. So I think there's some cross currents out there. Certainly for the early part of at least the consumer discretionary earnings season, some hand wringing, particularly around restaurants. And, you saw Target report today, disappointing numbers. TJX and off-price more broadly has just continued to execute really through all types of weather over the last 3 years. So really this shouldn't be much of a surprise, truthfully. It really is coming down to having the right product in front of the right people at the right time in an engaging manner. And that's just sort of what they do better than anyone.
Okay. Are there certain parts of the business that are doing well? Is it back to school sales, for example, that's giving the company a boost?
I mean, counterintuitively, and you would have a deeper appreciation for this, Canada is one of their best performing segments, which, if you look at Savers Value, who reported not too long ago, that's not the case for them. The lower income consumer they highlighted that as doing better than the average. But no, I mean, it's broad based across geographies and across their income cohorts.
Has the company been affected by tariffs? Have they had to raise prices at all?
They have in two ways. One, they do sell some product directly. And then, if prices come up across the broader economy, they have to react to that, right? They want to maintain a value spread to sort of their core comparable items in the market. But they're allowed to take price if those prices themselves increase. So they talked about fully mitigating the tariffs that they themselves have to absorb, which isn't much when compared to other retailers. And they spoke to being able to take a little bit of price because they saw prices in the broader market go up.
Okay, so who would be its rivals in the discount space?
Stores, we'll hear from them tomorrow, and Burlington, Walmart, clearly, for certain items.
Okay, so those are where consumers are also turning. What are the expectations for the Christmas season for TJX?
TJX, I mean, they talked about the momentum continuing, right? I mean, what you have here is branded goods that are constantly churning, right? Their merchants are constantly in the market looking for new items at a 30 to 60% average discount to what you would expect for the comparable item out there in the full price world, right? So just a formula that increasingly resonates with the consumer and only gains awareness and scale.
How big is a Christmas season for a retailer like this one? And then what happens for them in January, February?
Yeah, I mean, it's Black Friday, right? Because that's theoretically, historically, when these retailers actually turn a profit for the entire year. We're not there anymore. It's about 30% your average retailer's given year from a revenue standpoint, more so on earnings, or hopefully, right? Because you're doing that much higher volume on a similar sort of fixed cost base. January tends to be discount season, right? That's when everything goes on sale. You kind of move through what didn't sell over the holiday, and February is relatively dead as well. This year could be a little bit different in America. We've got this one big, beautiful bill where there's going to be some stimulating impact from tax returns. No tax on tips, tax on overtime, things like that could draw sort of a windfall from a tax refund standpoint. So you could see a little bit more of a bump, next year.
What is the growth for this company? Are they opening new locations? Are they expanding at all?
Yeah, they think there's about 7,000 stores across all their banners that they can have globally. They're about 5,200 today. The growth there is sort of low single digits. Their comp, they kind of guide to a 2 to 3%. So you're kind of cobbling together a mid-single digit top line profile. They've been more efficient. They've actually taken margin. This is one of their better margin quarters in history. So you're getting above that from an earnings growth standpoint, called mid to high, and then you're buying back and dividending out much of your free cash flow in a given year. And so there's sort of a total return profile in this one that approaches sort of a low double digit.
And what about AI? Are they incorporating AI? How would they use it?
I mean, these guys are barely on the internet.
Well, it's true, right?
So,
they don't have a lot of the same item in backstock, so it's not easy to order online.
Yeah, and they're not. It's not bleeding edge technology, right? They're not reinventing anything other than sort of merchandising fundamentals. I mean, they did speak on the call. They were asked. They did speak on the call to certain customer service functionality. Marketing efficiency is something that you hear from companies like this, right? If there's a way to more targetedly go after customers, certainly something probably in the next couple of years that more companies will be speaking to, but not front edge, bleeding edge from a use standpoint.
Good old,
nor does it need to be.
Yeah, good old hands-on, get into the store and pick it up and look at it and then buy it if you want. All right, Dylan Carden, thanks for joining us. Appreciate your time.
Absolutely. Take care.
So we're watching shares of Brookfield Asset Management today. That company's partnering with NVIDIA to introduce a $100 billion global AI infrastructure program and fund. We'll have more on that coming up. We are watching shares of Brookfield Asset Management, that company partnering with NVIDIA. Let's get more from Bloomberg's Leidan Oda joining us now. What are the details about this?
Basically, Brookfield today announced that it's targeting $10 billion for its first AI infrastructure fund, and as you mentioned, NVIDIA has committed to this fund. Also, Kuwait Investment Authority made a commitment, and the fund plans to invest around or to buy assets worth around $100 billion if we factor in the co-investments and the leverage. This fund comes as part of a bigger strategy or a broader strategy for Brookfield, which it announced in August. And basically what they're trying to do is that they are combining or marrying their expertise in renewables and infrastructure and real estate all into one AI strategy. And they want to be involved from providing energy to land and building out the data centers as well as compute. Brookfield estimates that the data center build out will require investments of around $7 trillion over the next decade. And we've already seen the voracious demands from big tech and from governments all over the world. The 5 biggest tech companies are spending around $400 billion this year alone on data centers. And we've seen billions poured into AI infrastructure from governments, including in France, in Sweden, and in the United Arab Emirates and Saudi Arabia. But also, of course, some investors are now starting to get jittery about an AI bubble forming because of the high valuations and because of the infrastructure. The AI infrastructure could be obsolete as it evolves quickly.
Okay, Leidan Oda, thanks for the update. Appreciate that. Coming up next, the closing bells on Bay Street and Wall Street. Stay tuned. Here are the closing bells for the end of the trading day. At the Nasdaq, Thomson Reuters ringing the closing bell. In New York, Optimum ringing the bell. And at the TSX, BlackRock ends the day. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Bit of a comeback day for the North American markets, with the TSX gaining 241 points today, up 0.8%. The S&P 500 gaining 24 points, but the Nasdaq 131 points up, or about 0.6%. Investors, of course, are eagerly waiting to hear from NVIDIA, which should be reporting shortly. They want to look at what that company is reporting for profit and revenue and what its guidance is moving forward. Tech stocks, of course, this past week have been pushed down. So let's take a look at the big movers so far in Toronto for the day. Celestica gaining today almost 5%, gaining $20.54 to $439.81. Let's go to MDA Space. It also gained 5.5%, $1.19 up to $22.83. And then Shopify up today. It's up 4.6%, up 38% on the year, Today it gained $9.04 to end the day 205.36. Atkins Realis, engineering firm, another company we've been watching, it moved up 4.8%, almost 4.9, gaining $4.11 up to 88.85. All right, let's go to Jeff Morgan. He's the deputy team leader for the Bloomberg News equities team, and he joins us to talk about the movers in Toronto. Jeff, Canadian tech has been having a banner day, considering tech for the past week has been pushed back down.
That's right. The Canadian tech sector actually outperformed the American tech sector today, with the information technology on the composite up about 3.4%. 3.4.
Okay. It looks like we have an audio problem with Jeff. We will try to reconnect with him when we can. Coming up next, the market's in the green today with miners and tech stocks leading the day. We'll get into the details when we come back. Bounce back in the North American markets today with the TSX up 241 points. Let's go back to Jeff Morgan, deputy team leader for the Bloomberg News equities team. Jeff, we missed the conversation, so it was Canadian tech we're talking about having a strong day.
Yeah, Canadian tech really, clobbering the U.S. tech sector by comparison. The TSX Composite Information Technology Index was up about 3.4% on the day, whereas the S&P 500 Information Technology Index was only up about 0.9%. Part of that is the gains from MDA Space, which, of course, had a really banner day as a result of the Canadian federal government's decision to boost investment in the European Space Agency, and BMO sees MDA Space being one of the key beneficiaries of that investment. But it wasn't restricted solely to MDA Space. Shopify had a banner day. A number of Canadian information technology companies, including Celestica, up really sharply today, helping drag the TSX higher, drag performance on the TSX, boost it on the day. Really, really a banner day from the Canadian infotech sector. Might be a little bit of positioning as well. We've had such a sell-off over the last few days. And we have NVIDIA results tonight. So if NVIDIA is good, the entire information technology sector may get a little bit of a bounce.
Okay, let's talk about investors looking for dividend-paying stocks. Obviously, some of that could be rotation out of tech.
That's exactly right. So what we've seen over the last few days has been this rotation into some of those higher dividend-paying sectors. In the U.S., that's been healthcare. And Canada has a number of, and a kind of a higher weighting in some more heavily dividend stocks. So it's an interesting factor that is being, that's kind of one of the most in-demand investment areas right now. The problem is that it's been so out of demand for the last several years that actually the dividend yield, if you look at the S&P 500, the average dividend yield is down at 1.14%. Which is near a historic low, and so people are looking for dividends at exactly the time when it's harder and harder to find higher dividends. So if you look at the stocks that have been the biggest performers in the S&P 500 over the last month or so, some of them have been these high dividend players. DuPont and Nemours, which is a chemical company, is one of them. The high dividend yield ETF, Horizon's high dividend yield ETF, has actually seen 5 straight months of positive inflows. Investors really are looking for those dividends, and looks like they are back in fashion once again, and more so now with some of those jitters in the tech sector that we've been talking about.
Yeah, we'll see how long they stay in fashion. That's to be determined. Bloomberg's Jeff Morgan. Thanks, Jeff. Appreciate it. Markets crossing back into the green, as we mentioned, in what has been a volatile time. Investors are wary about overvalued AI stocks and are paying close attention to NVIDIA's earnings, which are going to be out shortly. Let's go to Lara Lau, Chief Investment Officer at Brompton Group. She joins us now to talk some more about this. Lara, is there just sort of AI fatigue, as I heard one analyst phrase it?
Well, AI has been doing really well. Earnings have been very high. And I think what's happened is, especially like data centers, that demand has been just almost exponential. So the question is, how much more can it be? So I think that's a big question, because we are starting to see major bottlenecks in developing AI. Not really the software side, but certainly we're seeing bottlenecks on the power side and the components for the power. So I think we realize that there is some constraint on that growth. And even Microsoft has said that we don't have the physical resources to grow it as much as we like. The demand is there. We just can't catch up.
Okay, so is concern about bottlenecking what you're looking for in NVIDIA's earnings, whether that is something that is plaguing this company?
So what we are expecting is NVIDIA should have good numbers. They will likely beat expectations. But what we also want to see is basically the guide. They've been guiding $500 billion in data center revenues. How do we get there? So we would like more detail. We also want to see how their next generation chips, if there are any bottlenecks there, because in the past that has definitely been a bottleneck, which is Rubin. And also we'd like to know, although this is probably later on, what's going to happen with China, because that $500 billion does not include China. So with China, that number would obviously go up. So I think we all want to know what's going to happen. Is there going to be return on all this money being spent? And, there's also concerns about some of the circular nature, like everybody's funding everybody else.
Yeah. I wanted to ask you about whether you think solid earnings from NVIDIA would reignite confidence in the sector. And I ask because, as you know, we've had earnings that have been strong, but investors are still penalizing the companies.
I think that you need strong earnings, and you also need to guide to the future. Basically, we've seen, in the past, Jensen just say, the demand has been just so strong. So I think people are very concerned about the future. How long can the game keep on going? And we certainly see a lot more debt financing for these data centers as well. But in the past, it was more out of cash flow. So we're seeing more debt for that. So we want to see how long can this continue.
Do you see what's going on now with the rotation of money into other sectors as something healthy, even necessary?
Definitely, because really the game in town has been, technology. But if you actually look through the earnings has been stronger than expected across the board. And for you to have a sustainable rally, that's what we need. We need more than just tech to rally.
Okay. Are you buying at this point? If so, what are you looking at these days?
So what we're doing is, we typically run with very low cash. So what we have been doing is we have been doing some rotations. So, one good example would be in the past, if we wanted to buy something and there was a tie between U.S. and an international stock, we would choose U.S. Now we're actually choosing the international stock because we believe that there's more upside outside of the U.S.
Okay. Let's talk a moment about consumer strength, because Home Depot disappointed in earnings. Target, of course, has sales that are dramatically down. What's your read on the consumer in North America right now?
So the consumer is weak, and certainly it's clouded a bit with the government shutdown, because with the government shutdown and you're not getting paid, you're not going to start a new renovation project or any of that. And also we see people are very cautious. They're seeing more job layoffs. Interest rates are still high in the U.S. So definitely a very cautious consumer. We've definitely seen Target, who tends to be, like Walmart tends to be more groceries, more essentials, and Target tends to be more those things that you don't quite need as much, whether it be home decorations and such. And we've seen Target have more problems because people are just buying essentials, buying what they can to get by.
How does this sentiment among consumers bode for Black Friday and for the Christmas season?
Well, the good news is the government shutdown is done and they're going to get back pay. And with that back pay, we actually might get a better Christmas than expected. But, that being said, the prices are higher, inflation's higher, and the Americans are definitely going to see higher prices with tariffs. So I think that they will be a little more cautious, I think, going forward.
All right, Laura Lau, I'm going to leave it there, but appreciate you joining us on the program today. Laura's Chief Investment Officer at Brompton Group. Coming up next, NVIDIA releasing their latest quarter earnings today. We'll get into the details when we come back. For some, retirement is starting earlier, lasting longer, prompting some Canadians to worry about expenses once they do retire. CTV's Heather Wright has more.
The number of people living past 100 has more than doubled in the last 25 years. And for some, retirement is starting earlier and lasting longer, forcing tough financial decisions.
I think in the economy today, people have to keep working.
According to a survey from Manulife, 42% of respondents say they are worried about paying for basic expenses in retirement. That's up from 28% in 2020. 43% are worried about health care costs in retirement, an increase from 31% 5 years ago. And nearly half say their retirement savings are behind schedule.
That concern around day-to-day expenses, this is something that is a concern for pre-retirees and everybody. So it's not surprising to me that that would also be a concern going into retirement.
While the number of people retiring early is increasing, it's not always by choice. According to Manulife, only 15% of those who retired early did so because they had saved enough money. 33% retired due to their health, while 13% retired to care for a loved one, which is why experts say planning for various scenarios is key.
Disability is a reality as you get older, and especially amongst seniors. It's just really critical that we're planning for that.
Fiona Cassidy is among the 15% who retired early by choice. She says having a plan is key, and so is starting early.
Getting the benefits of accrued interest is, that's a smart way to do it.
Experts say another factor to consider when retirement planning is inflation. And while it dipped slightly to 2.2% last month, the cost of living is still putting a squeeze on those on a fixed income. Heather Wright, CTV News, Toronto.
Palo Alto just released their latest quarter earnings, and we're staying tuned for NVIDIA's numbers about to come out. Let's go to Ivana Delesta. She's founder, CEO, Spear Invest, to take a look first at Palo Alto. Thanks for joining us today. I'm going to read out some of the information for the viewers here, and then we'll talk. Adjusted earnings per share, 93 cents versus $1.56 year over year. The estimate was 90 cents. Revenue coming in at $2.47 billion. So that's a 16% increase, Ivana. The estimate had been 2.46, so very close, but a beat there. And then it looks at product revenue was up 23%. Subscription and support revenue was up 14%. Second quarter forecast here sees revenue at $2.57 billion to $2.59 billion. And then the forecast for the next year, revenue at $10.5 billion to $10.54 billion. The estimate had been for 10.51, so in the range there. What's your first take on the Palo Alto numbers?
Well, thanks for having me, Marilla. The headline numbers look okay, but the outlook looks a little bit weak compared to expectations. Remember, for companies to keep the momentum here, they are expected to have pretty decent beats. The overall revenue growth reported for the quarter was strong, but the outlook is a little weak. I also see that they announced an acquisition here, and they are already going through a prior acquisition. So I think the market could be also a little bit concerned about them doing too many deals at this point in the cycle.
Okay, and Palo Alto, is that a good deal for them, you think? Is that an acquisition that'll work with them?
Well, I think that they had a previous acquisition that is supposed to be large and it's supposed to close in fiscal 26. And the new acquisition that they just announced is Chronosphere for $3.5 billion. We would need to look further into the details to see the strategic rationale for this deal. But that's really the concern here is, are they going to be able to integrate these deals and get synergies?
Okay, so the NVIDIA numbers are just coming across into the newsroom. Let me give you a quick idea of what they are for third quarter. Revenue coming in at $57.01 billion, and that's a 62% year-over-year increase for revenue. The estimate had been $55.1 billion, so a very strong beat for NVIDIA there. Gaming revenue coming in 30% up year-over-year. Let's get down to adjusted operating expenses coming in at $4.22. So that was exactly on the estimate for $4.22 billion. They're looking at fourth quarter forecast revenue coming in at $63.7 billion to $66.3 billion. And the estimate had been for 61.98. So a very big beat for fourth quarter forecast as well. These are strong numbers, Ivana, that clearly investors and analysts had been looking for. And again, we don't have the details yet as to sort of what else is clouding, if anything's clouding the horizon for the company. But what's your take so far?
So the guide is actually pretty strong, especially for investors coming in concerned into this report. Going into the report, we had a lot of people being very cautious on CapEx spend, financing needs. The liquidity market is tightening up a little bit with weak macro. So people are concerned about how they're going to be able to finance these deals. Clearly, these numbers show that companies are able to finance deals, and NVIDIA keeps beating. The key will be on the call to look for any sort of color into next year. That's going to be really where they're going to have the transition come from the Blackwell to the Rubin platform. If that goes smoothly, we think there could be significant upside to next year's $300 billion revenue number. So that's really what we are focused on. But for the quarter, the numbers look pretty solid.
Okay, I do want to get to earnings per share, which came in at $1.30, and that beat the analyst consensus estimate of $1.25. So they're up there as well. You mentioned the Rubin platform and an adjustment that will be made there. I had someone talk about bottlenecks and the threat of bottlenecks slowing growth for a company like NVIDIA. Is that something you worry about? And if you can expand on that, if you do?
Well, really, the key bottleneck, I think people are concerned about demand. We're not worried about demand at all. So the key bottleneck, in our opinion, is how quickly you're going to be able to put these GPUs into work, right? So power is a bottleneck, but even more than power generation itself, it's the physical data center availability. So you really need to have not only source power supply, but also the actual equipment and infrastructure that you need for these GPUs on the ground. So this is why we think that there is going to be opportunities across the board, broadening out from just NVIDIA here. So all of the companies that provide power components, networking components, that's where we're seeing most of the upside going into next year. Optical components is another area that's been recently gaining traction. So we disclose all of our holdings on our website, but I think the upside is really going to broaden out just from NVIDIA, which was the prior generation Hopper platform, to a much broader set of companies. As you know, there's been a lot of push down of tech stocks in the last couple of weeks. We're looking at NVIDIA after hours trading here, and it's up over about 4% at this point, but it was gaining ground already ahead of the results being announced. Do you think this will turn the tide to bring investor confidence back to tech? Well, we're going to look for further color on the call to see if this is enough to boost the sector. I think the fundamentals are very strong of the AI trade. I think macro concerns have been weighing a little bit on tech just because of the liquidity and the CapEx requirements. But we're not really concerned at all about fundamentals. We think even post-macros, people should be using these opportunities to buy the dips in quality names that don't have credit issues and have plenty of free cash flow generation potential. So I think you need to be selective here in the macro, but I would say that it's important to keep buying the dips because the AI trade is in very early innings. All right, Ivana Delevska, the founder, CEO, Spear Invest. Thank you for joining us. Appreciate your time. Coming up next, the Fed minutes report for the board's October meeting has added more uncertainty about another rate cut in December. More in a moment.
Lowe's surging today despite the company lowering its full-year guidance in its latest quarterly result. We sat down with David Bellinger, director at Mizuho. He has a buy rating on the stock and says their fourth quarter is off to a hot start.
We had the bar set lower yesterday by Home Depot, reported about flattish comp sales. Lowe's beat that by a bit. They were up about 0.4%, so a slight beat. But that's the first time that Lowe's has out-comped Home Depot in about 8 quarters. So good momentum. And then there were a lot of fears around October slowing. What does the start to Q4 look like? And Lowe's came out and definitively said that same-store sales are growing positively into the start of Q4. We don't have the housing turn yet, but we do have some signs of better do-it-yourself engagement. Lowe's tends to cater to these small and medium-sized pros. They're very busy. So Lowe's is doing what they can before this eventual housing turn comes. We've been waiting for it for a couple of years now, but we think they're very well positioned. And it's not like sales are falling apart here, right? We're not talking about same-store sales down 5% or more. We're basically flat, but we're starting to get some better signs into 2026.
And you mentioned it sounds like it sounds like they found their market. What else are they doing right that help them outperform Home Depot right now?
Yeah, they've introduced a rewards program. So this do-it-yourself rewards, they've got 30 million plus members. So that's been taken off nicely. The one thing that we've spent a lot of time on is looking at agentic technology. So AI technology to help you shop. Lowe's has this Milo agent. They talked about today that they're seeing about 1 million consumer prompts per month, and the conversion rate on those consumers is almost 2x the normal consumers. So some nice early agentic adoption we're seeing for Lowe's. Maybe this lifts the whole home improvement category over time. You type in things like, hey, how do I build this deck? Or, hey, how do I redo my kitchen? It sort of lays out the steps for you and gives you the products that Lowe's sells, and you could easily convert to them.
And those are the positives. What are the potential headwinds?
Yeah, I mean, it's just more macro issues than anything. You've had stubbornly high mortgage rates. Affordability issues are clearly out there. We're all looking for the Fed to make more and more rate cuts, but it just looks like the mortgage rates have not participated in that down move, at least not yet. So we've been talking about this housing, home improvement recovery for a while now. This has morphed into a back half 24, back half 25. Maybe this moves to a 2026 recovery story. But we think there's so much pent-up demand here. There's a number out there. These companies have quoted something like $50 billion of underspending in the last few years. We think a lot of that comes back. Lowe's is really well positioned. Home Depot is really well positioned as well.
And how much longer do you think can they ride that if there's no rate cuts before we start seeing an impact?
Yeah, it's a good question because these businesses have very much diversified, right? So there's a lot to keep the lights on, right? Home Depot and Lowe's, they sell things like 10-foot tall Halloween decor items. I've got some of them, right? So there's these other items where they moved from not just hardcore home improvement, but like appliances. There's a wide spectrum of items. And then the big push lately is each of these companies have made a few multi-billion-dollar acquisitions into this complex pro space. So think about big remodelers, big home builders. That's where a lot of the growth in the sector is concentrated. And they're trying to get ahead of this wave of aging homes. There should be a lot of pent-up demand out there. And we think that Home Depot and Lowe's both made these acquisitions at hopefully cyclical lows, at not big acquisition multiples for certain of these acquisitions. So that's all building. Hopefully this comes in 2026, but it's definitely out there and it's on the horizon.
All right, now you have a buy rating on Lowe's along with Home Depot and several other companies in the retail sector. What makes you so optimistic about the whole, pretty much, can I say the whole sector or a large chunk of it?
Yeah, these are the big behemoths in the sector. A lot of what they're doing is just positioning the business very well for what's to come. And just look at the way these companies have handled tariffs, right? Take, for instance, Home Depot. They spent the last 3 to 5 years reworking a lot of their systems just to get great visibility on pricing as soon as that product lands in the U.S. or elsewhere. So they're taking these measured approaches to roll through pricing correctly. And then you've got all these distribution capabilities that came from that big complex pro, those type of deals. We're talking about offering trade credit to customers, on job site delivery, right? That's a big deal. If you get pros a lot of lumber, a lot of concrete to the site, don't have to come to the store. So that a lot of these little but building capabilities are pushing these guys into basically gaining more share as the market turns. We're just waiting, but we think the stocks are priced for a lot of this upside here.
Okay. It sounds like you'd almost describe them as nimble for big corporations, though.
They've managed the expense base extremely well. And for any retailer, labor is one of your biggest costs, right? It could be 40, 50% of your total expense base. So these companies have great dynamics where if foot traffic is weak, they'll pull back on labor accordingly, and then they can ramp it back up as sales come back. But yes, they've been very nimble, able to still keep earnings pretty tight, right? We're not seeing these big downdrafts on the EPS line for these businesses. So they're almost stabilized. And then you've got more of this torque, more of a upside story in home improvement versus other parts of consumer and retail.
David Bellinger, director at Mizuho Americas. Time for a quick break. We're back in a moment. We have the Fed Minutes Report, which gives us clarity on what led the U.S. Federal Reserve to cut the lending rate recently. Their next announcement is in December, but right now, Washington's still working on releasing some of the key data, which was delayed by the government shutdown. Let's go to Oscar Munoz. He's chief U.S. macro strategist at TD Securities. Thanks for joining us today.
Thanks for the invitation.
So no full October jobs report in the U.S. Does it matter for the Fed at this point?
Yeah, it matters quite a bit. Remember, the Fed, and we learned it from the minutes, the Fed is certainly very split in terms of the policy outlook, particularly around the need to ease in December. This means that it will be a close call. Some Fed officials want to see additional evidence of labor market deterioration before easing again. And some others, want to still pursue risk management rate cuts. So that's where we are. Data usually tends to settle debates at the Fed, and the lack of data, well, doesn't help with that, right? So if you're on the hawkish side, you want to see additional labor market deterioration, but if you're not going to get the October or even the November payrolls reports before the FOMC meeting, that makes it a little, the case for rate cuts is a little harder to make.
Yeah, even with November data, as you mentioned, is getting now pushed to December 16th after the Fed's final meeting. So do they have alternate data that they can rely on?
No, definitely they do, and we're actually tracking that. If you look at, Homebase, if you look at, Revelio, you look at ADP data, job openings as well from Indeed, everything is pointing to a labor market that's continuing to cool down. So that's suggesting that, but Fed officials want to actually wait for public and official data in order to tell them what's happening. And so in that sense, tomorrow's September NFP report will be important because it will be the last one on the employment side before we get to the December FOMC meeting.
Okay, so in the minutes released today, many officials said it was likely appropriate to keep interest rates where they are for the rest of the year. You mentioned what you've seen so far shows a continued softening. Significant enough, you think, that would lead them to change their minds?
Look, that's our view. We still think that they ease in December, but the lack of data certainly increases the odds of them pausing. It could be a dovish pause in terms of what they guide for 2026. If they pause in December, they may resume to rate cuts in January or even March. But again, it will depend on the data. No matter what the alternative information that we have access to, high frequency, ultimately they want to see what the jobs report is saying, how the unemployment rate is behaving. What jobless claims are suggesting. So at the end, we have all these moving parts on the private sector side, but at the official public sector data is really what's going to determine how the Fed reacts to employment and CPI inflation conditions.
Is consumer sentiment something they ever take into account?
At the margin, I think that's for the most part lower tier data. I think inflation expectations are certainly something they look at closely. But if you look at post-pandemic, particularly University of Michigan, sentiment has been up and down. It hasn't been really a good predictor of consumer spending. So consumers usually respond one way to the surveys, but actually turn around and do something completely the opposite. So I think it has lost some prominence in terms of with the data that the Fed watches. Again, that's why you have to go back to more hard data, particularly when talking about the labor market. Okay, so if they don't get sort of that trove of data until after their next meeting, and it doesn't come until sort of the end or closer to the end of the year, what are you predicting or looking at for the start of next year, considering we don't have that data, they'll get it late? Or is it possible there could be a deeper cut if that data that comes out is weaker? Oh, definitely, definitely. We saw that last year. Remember the Fed, when they surprised the market with a 50 basis points rate cut in September 2024, they had said in the prior meeting they wouldn't ease. In the interim, you saw the labor market and jobs data coming weaker than expected, and they decided to catch up and did a 50 basis points rate cut. That could be a possibility here, right? We're going to get 3 data points on the payroll side after the December FOMC meeting. We're going to get November payroll data. You're going to see the backfilling of the October data, and then you're going to get the December data in January. All those 3 data points before the January FOMC meeting. So depending on how the data evolves, is going to for sure determine what the Fed does. If jobs data turn very, very weak, you get negative payrolls numbers, or the unemployment rate starts to move higher to the 4.5, 4.6% range, definitely that would argue for the Fed to move a little faster, quicker than markets are assuming. All right, I'm going to leave it there. I'm out of time, Oscar, but thank you for your time. Oscar Munoz is with TD Securities. Coming up, Microsoft, Amazon often sound like good investment options, but one analyst has downgraded both of them. More in a moment. Tech and e-commerce giants Microsoft and Amazon have been downgraded at Rothschild & Co. Redburn to neutral from buy. We got more from Alex Heisel, analyst at the firm, who says it's time to take a more cautious stance on hyperscalers.
The market is already pricing in, a very optimistic scenario in terms of like how much value generative AI really creates for both of them, for Microsoft and for Amazon, because everyone is still using, the traditional cloud playbook where the hyperscalers have been the kings of the cloud 1.0. And so if you look at it from a capital deployment and value creation perspective, in the cloud, they've converted one CapEx dollar in $1.4 of NBV. With generative AI, we're talking about one CapEx dollar of 20 cents of NBV. So I think there's a big mismatch. And unfortunately, we don't see a clear path for both of these companies to revert back towards these cloud 1.0 economics, because now you also have like new platforms in the game in the form of like Anthropic and OpenAI, because they are not just the apps, that consumers see. They act as a platform layer, and that's where the value is. So it's much more competitive, and we see the risk that the hyperscalers operate much more in the lower part of the stack.
Now you have Microsoft. You mentioned Anthropic. Microsoft's investing $35 billion. Is that not going to ease that or ease your fears a little?
I mean, what will happen is Anthropic will use Microsoft infrastructure as it does with AWS and GCP. But for the hyperscalers, it mainly means like server rental and maybe some auxiliary services. But the value really accrues to the likes of Anthropic and OpenAI. So we have to really differentiate what is like a server rental versus like what is like the product on top of these servers, and who actually captures the value in this.
What are some numbers you would like to see that would make you feel more comfortable with them?
What I would like to see is sustained reacceleration of growth, but CapEx coming down. Because unless we see this scenario, then the only conclusion that you have is the costs to grow are really high. If we would see CapEx coming down and the revenues accelerating, it means that basically the revenues per unit of compute is going up. That's what we need to see really to reassess our view.
And one of the things, of course, everybody's talking about AI, but also the other thing that we've been talking about is quantum computing. Where are your thoughts on that? Where do you see these companies going with that?
I'm probably not the right person to give you a really good insights in quantum computing, because my focus is really just on the hyperscalers.
On the hyperscalers, and
yeah.
And how much of an impact do you think NVIDIA's earnings today, when they come out after the bell, will have on these two, on Microsoft and Amazon?
I think the impact will be quite limited, because we have been in this period where the market has rewarded growth and capex, but with the recent earnings season from the hyperscalers, Amazon and Microsoft, the growth was decent, but the market is starting to look beyond the surface level top line and also like the RPO figures. So I don't think there's much of an impact, because investors we speak to all try to get a head around what the value is. So I think it's getting much more nuanced, and I don't think there's any real impact from tonight.
Okay, and what gives you this confidence on these two with this?
Because that's what I spent most of my time. I really focus on the hyperscalers, Amazon, Microsoft, and also Oracle. And I think what gives us confidence is because since we've launched in June 2022, we have been defending these companies throughout that period. We had an above consensus view in terms of like re-acceleration, and it was a challenging time. So we had to turn every stone, and we wouldn't have made these changes without being very sorry in the work we have done.
And do you feel moving forward they have the abilities to adapt and change?
I'm sure they do. I mean, just to be very clear, the returns on this, generative AI deployments, being it like GPUs or for AWS Trainium 2, they're still okay. So we're looking for an IRR of like 15-16%, but it's not the same as the Cloud 1.0. And what we said is the problem is the market still prices these companies as if it was still a Cloud 1.0, meaning that there is a belief they can revert back to where they have been, and I think there's just no clear path.
Alex Heisel, analyst at Rothschild & Co. Redburn. On Hot Picks, we looked at 3 plays in the utility sector. We were joined by Daniel Rich, Senior Equity Research Analyst, CFRA. And we kick things off with his top pick, EverSource Energy, he says, is trading at a discount when compared to its peers in the utility sector.
EverSource Energy actually picked up a bit of bad news this morning that I can explain. So EverSource is an electric utility based primarily in the New England region, so Massachusetts, New Hampshire, and Connecticut. And they've had some regulatory troubles in recent years in terms of local regulation that has put the stock at a discounted valuation relative to peers. Now, we are very bullish on the name because of the discount. We think that the growth potential in terms of earnings per share growth and capital expenditure opportunities in the region, as well as dividend growth, are pretty competitive with the peer group. And meriting a better valuation. Now, this morning, the stock is trading down a significant amount because the Connecticut Utility Board basically denied EverSource's ability to liquidate or divest its water utility in the state. It's a minor business, 2% of the revenues in 2024. And why we think the stock is down is primarily because of what it says about the regulatory environment in Connecticut. Not necessarily that the water business is so significant, but if regulation is tightening, that is going to put pressure on shares. Now, again, going into this morning, we held a strong buy opinion, and we saw, like I said, the growth potential in terms of their rate-based growth, their ability to grow their asset base. We're expecting around 8% annually over the long term, which is quite competitive with the peer group. And the dividend yield is 4.3%. Up until now, it's probably even higher with this news. So we will need to rethink our decision here based on this news. But again, I think it's primarily potentially an overreaction, really, based on regulatory concern and not so much a financial difficulty, whether or not they can divest the water utility.
And you may have touched on this, where is their core customer base, EverSource?
New England, so primarily Massachusetts, but also somewhat in New Hampshire and Connecticut. And like I said, Connecticut's sort of the thorn in their side right now in terms of local utility pushback, regulation pushback. So again, we saw shares trading over 20% discount to the peer median before this morning. Now we're probably looking at 25 to 30%. And this is a stock that historically is traded around 16 or 17 times forward earnings. And now we're looking at a stock that's probably south of 13 or even 12 times earnings. So again, unless the company comes out with some significant guidance change after today's decision, which I don't expect, we do think that there is considerable upside potential here for long-term investors in Eversource.
Your next idea, a huge player, Duke Energy. What attracts you there?
Right. So Duke Energy, this is one of the largest electric utilities in the United States, long-term, sort of traditionally run name, and they are primarily based in the Southeast, so North and South Carolina, Florida, as well as the Midwest. They have operations in, for example, Ohio and Indiana. So Duke Energy is one of the names that we think is leading the way in terms of the infrastructure build out for data centers and artificial intelligence that's going to be needed in this country. Their capital expenditure plan was recently increased from $87 billion to what we think is going to be $95 billion from 2026 to 2030, which is significant in terms of the electric transmission distribution, natural gas distribution, and new electric generation capacity in terms of gas, but also renewables to power all of this electricity demand that we're seeing. So they're projecting what we think is a pretty attractive pace of electricity sales growth in their service territory. Next year, somewhere between 1.5% and 2%, and then an acceleration of electric sales, 3% to 4% growth from 2027 through 2029, which is well beyond historical norms. And we think also customer growth in their territories, particularly in the Carolinas as well as Florida, is very healthy. It's also supporting their ability to, at the regulatory level, get all of this capital spending approved. And we do think it supports a potential earnings acceleration towards the end of this decade. For right now, Duke tends to grow their earnings about 6 to 7% annually in terms of earnings per year. What we're expecting is towards the end of the decade, think maybe 2028, 29, an acceleration maybe to the 7 or even 8%, which would put it at what we think is a higher echelon, a more competitive valuation relative to peers. The shares do yield 3.6% of dividend currently. And like I said, the data center trend, especially in North Carolina, is attractive. Amazon Web Services had a $10 billion investment that they announced recently going to support Duke Energy.
We'd better keep it moving. I'm sorry, you've only a minute left for your last idea. Sorry about that. Sempra Energy, what attracts you to this stock?
Right. So Sempra, this is a company that is primarily based in California and Texas, two very attractive markets, especially the Texas market, which is probably one of the fastest growing in terms of electricity demand and data center growth. This is a name that we think, after a lot of divestitures of non-regulated businesses in Mexico, for example, and a lot of their liquefied natural gas terminals in Central America, they're expected to see their earnings sort of bottom this year and then accelerate in the future. They're having an attractive 7 to 9% growth target in terms of earnings per share. We think they can reach the top end of that potentially. And like I said, because of their divestitures of non-regulated businesses, the earnings mix of their regulated operations is probably going to be close to 100% as opposed to about 80% today. So we think it's a less risky play, and the valuation should benefit as a result.
Daniel Rich, Senior Equity Research Analyst, CFRA. A quick recap here as we head towards the end of the show. NVIDIA, of course, reported earnings and strong revenue for its latest quarter. It was up 62% year over year. You can see in after hours, investors are liking that. It's up to 193.61, a gain of 3.8%. On the hour gain of $7.09. So again, an indicator for NVIDIA, which could be an indicator for the rest of the tech sector, a bit of a comeback. Palo Alto Networks also reported boosting forward revenue forecast and announced it's going to acquire a platform called Chronosphere for $3.35 billion. That does it for the close. Thanks for joining us today. We'll see you back here tomorrow.